Hey everybody, welcome to the webinar that we're putting on tonight, Deep Dive into Syndication. This is actually part of a series that we're going to have where we go into all the offering docs required in a real estate syndication. And we are so honored and fortunate tonight to have Mauricio Rold, who's a syndication attorney from Premier Law Group. And my name is Ryan Gibson, and I will be kind of the co-host of the webinar. Mauricio, how you doing?
I'm doing great, Ryan. Thanks for having me. Really appreciate it.
Yeah, you're welcome. Why don't you go ahead and just tell us a little bit about yourself, your background, what you kind of do in the real estate world, specifically in syndication.
Yeah, so I'm a syndication attorney, and I represent almost exclusively real estate investors, but certainly have had in the past some business owners as well. But most of my clients are real estate investors who are buying real estate. I've got a couple of real estate investors who kind of branch off a little bit and do some crazy cryptocurrency funds or what have you, but generally it's real estate. But that's what I do. My 100% of my practice is syndication law. I help obviously clients raise the money, make sure that they stay in compliance with both federal and state laws, really try and make sure they stay away from being cellmates with Bernie Madoff, right? That's kind of the idea. So I've been doing this for quite a while. Started my career like every other attorney dreams of. I worked at a pretty large law firm right out of law school and did a lot of securities work back then. I used to represent sort of the big boys, the JP Morgans, Prudentials, Merrill Lynch's of the world. But I was doing litigation, so it was a little bit different. I would usually get the case, obviously, once the you-know-what hit the fan, and I would get the complaints, and I would defend these guys, and just went through that whole process, going to trial, depositions, arbitrations, appeals, motions, all that kind of stuff. And quickly realized that's not what I wanted to do for the rest of my life. And just very fortuitous for me, I came across the little purple book about 15, 16 years ago, the Rich Dad Poor Dad, which I'm sure a lot of your listeners have heard before or read before. And that really changed my life dramatically because it kind of affirmed things that I kind of had the little voices in my head telling me. And when I read the book, I remember just saying, not out loud, but just like I was yes, yes. Like every point he would bring up, yes, yes, that's exactly right. So that was huge for me. And that was really fortuitous because literally a couple of weeks later, as I tell the story, I was driving around in Southern California and I hear Robert Kiyosaki's drop-in for the real estate guys. And I think it still goes around, but it goes something like, hey, this is Robert Kiyosaki, author of Rich Dad Poor Dad. If you're serious about investing in real estate, check out the real estate guys. They really know what they're doing. And at the time, I was obviously interested in real estate. And so I ended up attending the real estate guys' first Southern California event that they'd done. They had a huge membership thing up in Northern California, and they were expanding down to Southern California. So that's kind of where I met Robert and Russ. And, long story short, I ended up going to work for them. They had a development company, and they have obviously a lot more businesses other than just the radio show. And I became their general counsel, did all of their syndications back then. They were doing a ton, so kind of helped them do all those. And then sort of slowly but surely started helping out a lot of their members, and it kind of developed into a little bit of a side business, and with their permission, of course. And that kind of blossomed. And in 2006, started my own firm, Premier Law Group. Kept obviously Robert and Russ as my VIP clients, but kind of expanded the practice to where it is today. And it's kind of a thriving practice where I just focus exclusively on syndication. In the past, I do other things like asset protection, and really when you start a firm, it's like whatever puts food on the table, right? But
Absolutely.
But at this point, it's 100% syndication work and really laser focused on that. And that's kind of what I do.
That's a great background and good context with the real estate guys. I actually met you in 2000, I think it was 2015 when I attended the Secrets of Successful Syndication in Dallas. Right. And, great conference for learning about syndication, and then obviously a great conference for networking for folks like yourself to learn more about syndication. So, well, that's great. Just a quick background. I think most of the folks in the webinar know who I am, but Ryan Gibson, Chief Investment Officer at Spartan Investment Group. We basically use syndication as a tool to go buy our projects, raise the equity, take down a project. We do primarily real estate development of self-storage, and we buy existing self-storages and then expand them through adding more units, and then we operate them through disposition. And our company does the whole thing. We do everything from the capital raising to the operations to the direct third party and asset management to the disposition, the construction, all the way to the sale. So without further ado, we'll go ahead and jump into the webinar for tonight. So we love to give our disclaimers, as sure Mauricio will appreciate. We're not offering advice, seek outside counsel. This is just a general overview, so seek your own due diligence. Information contained is subject to change, and obviously perform your own due diligence. So with that out of the way, I just wanted to kind of make an announcement. We are going to be offering at Spartan a complete educational series. So tonight you'll see the orange highlighted. We're talking about operating agreements, but there's so much more to a syndication, such as the private placement memorandum, understanding your capital account, a deep dive into self-directed retirement accounts, which is something that you can do to invest in real estate syndications, how to complete due diligence on a sponsor, and how a K1 can impact your tax return in real estate syndication. So these are kind of the upcoming webinars that we're going to have. We do them at least monthly, and we have different subject matter experts like Mauricio to come join us and provide our investors and even other operators out there with value add, so that they can, when you get a private placement, you can really be sophisticated and understand everything that's in those offering documents and what it means to you as the investor and how it can protect you as the operator as well.
Hey, Ryan, can I make a quick point about your last event, the K1s?
Sure.
I literally am in the middle of unpacking a complete mess from a client who wasn't a client when they did the raise, but one of his partners, essentially, in my mind, was a crook and essentially switched the investment. And so the investors were part of an LLC, and then he just switched them out, and basically they're no longer members of the LLC. But people started getting a different K1, and that was kind of the tip off. But the K1, even though the name of the LLC was very similar, the EIN number was very different, even though the numbers looked pretty similar. So it's really important for you guys to really take a close look when you get that K1 and not just assume it's all correct. I would recommend going through it with your CPA and making sure it's accurate, because that can definitely tip you off on some things that may not be going right in your syndication.
Absolutely. Yeah. And that's why, some of the feedback that I got from the best ever real estate conference, which happens every year in Denver, Colorado, the third weekend of February, a lot of investors just, they don't understand the K1. They don't understand how it interacts with their tax return. When they get one for their self-directed retirements, they don't think it applies. There's just a lot of ambiguity and just misinformation out there. And I think the K1 webinar will be really, really impactful, I think, and we'll probably try to move that up maybe in the schedule a little bit. So since, if you extend it, obviously, we're still kind of in the tax season for 2018 if you're not filing until later on this year. Well, great. So just to kind of zoom in tonight, Mauricio is going to take us through kind of the ins and outs of the operating agreement, but just a kind of high level, we're raising funds generally through a Regulation D offering, which the SEC allows an exemption for. And there's different ways that somebody can come into an investment. They can come in through debt or equity. And tonight we're talking about equity investors that actually own a portion of the single asset LLC that's buying the property, or that's kind of hosting the syndication. We're not talking about a debt investor. There's obviously pros and cons to both. We're talking about you having direct ownership in a project, sharing in the risks and the rewards, the return not being guaranteed. There could be a higher return potentially. And typically equity is paid after all expenses are paid and after debt service is paid. So we're going to kind of go through tonight on the equity side of things, not necessarily the debt where you're acting as a lender and you're going to maybe getting a promissory note and a deed of trust and a guarantee, more of a guarantee secured by a lien or a personal guarantee. So tonight we're going to be focusing on the equity. So Mauricio, let's talk about required documents in a syndication. We talked a little bit about all the things that we can go through in future webinars, but tonight we're talking about the operating agreement. But what about these other documents? How do they sort of play into the operating agreement? How do they interact with each other?
Yeah, great question. These are all what I call part of the offering documents. So they all are part of this package that you're going to be giving to the investors. Always start with a business plan, and the business plan is really your marketing piece, your marketing tool. It does have a little bit of legalese, but it's really, the reason why investors are going to invest in your project. So this is where you would put all the details about the property, what your game plan is. Most people are raising capital and they're buying a property and they want to improve it to increase the NOI, increase occupancy, drive the value up, and either do a refinance or a sale. And that's your business plan. That's what your game plan is. And so that's where all the details go. And I always, well, I'll joke about the next one, but that's the marketing piece, right? And I spend a lot of time with clients on that piece alone, because even though it's not a legal document, it has to make sense. It has to add up. And sometimes, especially when people are working with pro formas, which is something else that at some point we'll talk about, that are in the business plan, the numbers don't always add up. And I do a deep dive into that, and I analyze the numbers, and literally a lot of times it just does not add up, or it's different from the way the business plan is explaining the numbers. But the business plan is basically your marketing plan. I think most people kind of have a feel for what that is. The private placement memorandum is the document that discloses all the risks in your investment, tells the investors all the ways your investment can go wrong. I love the analogy, and I just put it on my Facebook feed a couple of weeks ago, because I always give the example from stage about many, many years ago when I had oral surgery. And I think I just took out a wisdom tooth back then, but I just had oral surgery again a couple of weeks ago. So, when you go into the hospital, or in this case, the oral surgeon, and they give you that medical consent form, usually it's yellow, but it tells you all the ways that this removal of my wisdom tooth can go wrong, and it can cause bleeding, it can cause infection, it can cause this, and cause that, it can even cause death. And that's what a private placement memorandum is. It's just all the ways your deal can go wrong, so that the investor can ideally never come back, and if the investment goes south, they can never come back and say, wait, I had no idea that was a possibility, that this could happen or that could happen. You should be able to always point to your private placement memorandum, as we call it, a PPM, and point that out. I always joke, and this is kind of my joke, I'm sure it's not that funny, but I always joke that your business plan almost has to oversell the deal, because they have to get over the hump of the PPM. No one is going to invest in your deal based on the PPM. If anything, they're gonna run, because they're gonna see, oh my God, I can lose all my money and all these things. So definitely need to tee them up a little bit and let them know, if it's the first time they've read one, just to let them know what it is. But you kind of have to sell them, because they'll definitely get scared. I always laugh when people say, well, send me the PPM, then I'll make a decision. And like I said, nobody's gonna make a positive decision anyway based on the PPM. Questionnaire is very important. It essentially identifies whether your investors are accredited or non-accredited, and to the extent they are non-accredited, an idea of what their net worth is and their income. And the reason for that is twofold. Number one, many exemptions that we have either prohibit non-accredited investors, so we want to have some kind of a questionnaire that makes a representation that everyone is accredited, or it limits the amount of non-accredited investors. In a Reg D 506, for example, 506B, which is probably the most common, you're limited to 35 non-accredited investors. And so this questionnaire is something you want to have in your back pocket. Again, if something goes south and you get audited and the SEC is looking over your shoulder, you can produce documents that show, hey, we only have 20 non-accredited or 15, and you didn't go over the 35 limit. So that's critical. And the other important piece is, if you are taking non-accredited, you typically don't want to take all of their money, right? So if they're non-accredited and their net worth is 100 grand, you don't want to take 100 grand of their money. And so this document outlines, or requires them to put that information in there, so you can make a good judgment call and determine whether this is a suitable investment for them. And there's no law, in theory, I guess you could do it, but there's no law. But a good rule of thumb is, for non-accredited investors, is don't take more than 25 or 30% of their net worth, or even their income. So that's the reason for the questionnaire. The questionnaire is something, by the way, just real quick, I don't want to spend too much time on it, but we can rely on the questionnaire if it's a 506B. And I know we didn't talk about too much about different exemptions, but just know that in a 506B, there is that self-certification where if an investor checks the box and says they are accredited, you can rely on that representation. That's what the questionnaire is for. Other exemptions, like 506C, requires you to take what's called reasonable steps to verify that they are accredited. And even though we do present a questionnaire, them filling out the questionnaire is not going to be sufficient. So we are going to have to take other steps, like reviewing tax returns or W-2s, or bank statements or appraisals, or whatever they're relying on, like the accreditation status. So that's the purpose of the questionnaire. And then the subscription agreement is really the official document that legally binds them and actually makes them part of the membership. So that's where they're going to put how much money they're investing, all of their information, their tax ID number, and that's when they sign. And in theory, and I say in theory because there's an argument to be made, but I always like to make the counter signature of the subscription agreement as the official date that they are entered into the company. So I typically recommend that sponsors wait till the very end so they can accept all the subscription agreements and all the docs, and then they can just sign them all at one time and send them all back at the end. So at least we have an argument. And this has to do more with some filing requirements that you have within a certain time frame, and specifically the Form D. Those of you that have done one before, there's a Form D requirement within 15 days of first sale. And so, by arguing that the first sale didn't occur till later in the timeline, at least I have an argument. If we blew that 15 days, I can go back and say, well, we didn't really sell the investment until the date that I actually signed it, which is much later than you may argue. So that's kind of a brief overhead on the other docs.
Perfect. And just for the Spartan investors out there, the business plan is kind of what we consider the offering memorandum. And then we also have an additional document that goes behind that kind of breaks down all of our financials and business plan that's kind of kept to our operations team.
Yeah.
Very good, high level.
And that's a great point, by the way, Ryan. And that's probably going to be a theme throughout this webinar, that there's no one way to do things, right? So everybody has a slightly different way of doing it. Most of the time, that's fine. There's obviously sometimes people do something that is not legal or something, but there's no proper way, or there's not like this is the way the operating agreement has to be, or this is the way you have to draft certain provisions. I mean, everybody's got their own way of doing things, and that's a great example. Some people have a business plan. Some people have an executive summary, and they have the rest of it upon request. Some people separate the financials from them. So there's not one size fits all. So that's a good point of how
Absolutely.
you guys do it.
Yeah, and I just wanted to also just make a point too that if you are receiving an offering, or somebody's trying to raise money from you as a passive investor, and you don't see some of these documents, and
oh my gosh,
and you're investing
in
a project and expecting to be completely passive, so you're expecting to invest with somebody and get a return in exchange for investing capital, and you're not receiving these documents, turn the other way and run very fast, because that means that they're not doing the exemption correctly, or they're not filing the necessary paperwork with the state and so on. So just want to kind of put that out here. If you're receiving, somebody is buying a bunch of property and they want you to invest it in, and there's no paperwork that goes along with it, and they've just been doing that way for a long time, that's fine and great for them, but they're not doing it correctly. So
Ryan, quick story about that. Quick story, real quick. So I used to, and I don't do this anymore, but back in the day, people would ask me to review the docs. Limited partners would ask me, hey, do you mind? I've got this PPM, I'm investing in. Do you mind taking a look at it? And I would. And twice I'd come across situations where literally they did not have a PPM. And when I pressed them about why they didn't have a PPM, they came up with some answer that didn't make sense. It was like, oh, this is we're not raising that much money, or it's friends and family, or what have you. It was definitely not a legal thing. And not only that, but the other docs were missing too. Like the business plan wasn't really a business plan. It was kind of like an educational generic thing. Anyway, so that happened twice. And I remember telling the guy specifically, I say, well, the good news is, the penalty for not doing it correct realistically is restitution. So if they lose your money, again, to the extent they have it, they're going to be required to repay your money, even if you lost it plus interest. But without fail, both of those scenarios, a year and a half later, I get phone calls from those guys, and sure enough, told me that the deal went south, and there's actually one of them had some fraud. Because if they're cutting corners at that level, if they're not doing everything right, that probably means they're not working with a syndication attorney, an SEC lawyer. This is definitely not a do-it-yourself project. Other things you could argue, like setting up entities or asset protect, that you can do that on your own. You can go to LegalZoom, what have you. This is definitely not a place where you want to do that, or certainly not do anything on the cheap. So if they're cutting corners, not hiring an attorney, not doing a PPM and all that stuff, where else are they cutting corners? So those are definitely red flags when the documentation is not there and the explanation for not having them just doesn't add up.
Absolutely. So let's just kind of go. We're on the operating agreement overview slide. So I looked at Mauricio's operating agreement. I looked at our operating agreement. Again, they're all kind of different, but generally they have all these sections. So there's about 15 sections that I have up on the screen. And I won't sit there and read them all to you, but you'll see the highlighted orange. Those are the ones that we're going to focus on tonight: organization, members, management, capital contributions, allocation of profit and loss distributions. Not that the other ones aren't important to have in your operating agreement, but there's still a lot of standard language, and the organization will be different, the distributions will be different, the member structure may be different. So we're kind of focusing on the things that we could sort of substitute in and out, and sort of where you should kind of zoom in and see, like, okay, how is this company being organized? so that I can make a decision on if I want to go into an organization like this with an operator, right? So, um, and we can kind of just jump over to the next slide. We can just dive right into the organization unless you had anything to add about kind of an overview.
No, I'll take your lead, because I mean, this is you
It's
can
a
definitely,
lot.
number one, you can spend 20 hours. You can do if you can do a 3-day seminar on this slide, number one, and we can also cure insomnia if we go into super detail. But I know there's some points you want to highlight, and I think we should. So I'm going to take the lead on with what you want to highlight, and then we can dig in a little bit deeper on what you think is the sort of, maybe use the 80-20 rule and figure out what makes the most sense to dive in a little bit.
Sure. So, okay, let's talk about the company section, how the company is organized. So I have that
Yeah.
slide up, organization. I've seen the gamut, right? I've seen, company, the manager can do whatever, literally whatever he wants or she wants,
Yep.
more restrictions on what the manager can do, and everything kind of in between. So talk about, sort of the left and the right limits on what a manager can do, what their responsibilities are, how a company is organized, sort of, what they're investing in, what they're not investing in, so on and so forth.
Yeah. So the organization section will clarify kind of one of your earlier slides, simple things like, look, this is an equity investment, right, versus a debt piece, and you're actually becoming a member in this LLC, not getting a promissory note. To the extent which typically in my operating agreements, I think it's pretty common, you have different classes of memberships or different classes of members. So this will outline exactly what membership level you're getting into. For example, I'm actually literally doing one right now where we have 3 different types of investors. So we have, class A1, class A2, class A3. And this is a section that would kind of go into the details of, number one, which one are you investing in? And number two, what are the specific, preferential treatment or voting rights or what have you for those particular classes. The purpose of the entity is important too. So, what is it going to do? Your third point there was, we're going to invest in property. So that assures you that they're not taking your money and, going to buy, cryptocurrency stuff, or maybe even if there's a property in the US, they're not going to go buy something offshore. They're not going to go to Vegas and put it on black, and all that kind of stuff. So that kind of puts the parameters on it. Certainly, we don't want any commingling in any of that, so that definitely should be in there. Let me go back to the top one. A single asset LLC. Sometimes it is single. Well, sometimes you can have single asset for sure, and a lot of the banks will have sort of a single asset. Or actually, it's more like single purpose entity as opposed to single asset, because sometimes people do buy portfolios. So, for example, I do a lot of clients who like to buy single family homes, but because they're so inexpensive, they're 80, 100 grand, they buy 10 of them, right? They go raise $1 million and they go buy 10. And you don't want to have all 10 of them in that one LLC. So we'll generally split them up into some sub LLCs. So all that information would be in how the company is organized. That's why it's really important to get that down well. And ideally, a good actually more maybe on the PPM or the business plan, but a good business plan would have sort of a little organizational chart too, to help you kind of see visually how this company is organized and how it relates to everybody else. So that's kind of my 2 cents on that.
Yeah, generally, and kind of what I've learned in investing in, in other people's projects, and then obviously hosting our own syndications for our projects is, I want to make sure that the organization is doing exactly what the business plan says, and there isn't any caveats in the language that allows the money that I invest to go to other projects, right? So I think, I don't know, for me personally, and just something to look out for. If you only want to be in that one project, make sure the organization of the LLC is set up that way, and that's kind of important.
And Ryan, that's a great overarching point. And I sometimes take these things for granted, and I shouldn't. So the operating agreement. So let's step back a little bit. Let's go back to the 10,000 feet level. The operating agreement is designed. That's where the rules and the regulations and the execution of all of these policies and procedures get articulated, and that's the governing document. So if there's ever a dispute, hey, you said this, you said that, or hey, I want to do this, I want to do that, we always go to the operating agreement. So the PPM, for example, it might be in the PPM, but the PPM it's a legal document, obviously, but that's a disclosure document. If the PPM says one thing, but the operating agreement says something else, the operating agreement is the one that's going to govern. So your point's well taken that you want to make sure that whatever is in the business plan, for example, they may say for example, if the business plan is promising an 8% preferred return, and I think we're going to talk about preferreds in a second, but if it's giving you a preferred return of 8%, but the operating agreement says 7%, well, you're going to be getting 7%. And if you argue about 8 or whatever, then the operating agreement is going to govern. Now, you may have other issues. You can have complaints because now they're misrepresented. You promised me something. But when it comes to the execution, the operating agreement is what's going to govern.
Wow, that is an amazing point. I mean, so throw your marketing materials in the trash. Read the operating agreement. I think that's why I think that's why we wanted to talk about this tonight. Is we want to make sure that what it says in the operating agreement makes sense to you.
Yeah.
And I know, Mauricio, I asked you before the webinar started if you kind of help people review syndications before they make an investment decision, and you said that you didn't really do that. You're kind of more on the organizing a syndication for an operator.
Yeah.
But you do have referrals to people who could help somebody review offering documents. And I encourage everybody on the call or listening to this webinar, make sure that you actually have your legal team review the offering documents before you make an investment decision. Because you could be getting into something and you think it's one thing and it's another, and maybe it's because it's the way the language is written. And if the operator or the sponsor doesn't want to talk about it and go line by line, or worse, even says something like, "Well, I've never even looked at that," it would definitely cause some concern for me. And we have another webinar on doing due diligence on a sponsor coming up later, but that's kind of the kind of early signs of well, if they don't really want to go through the operating agreement with me, or they're really they don't want to answer the questions, or they don't want to they don't want to hear what my attorney has to say, that's kind of some red flags, I think.
Yeah, and let me give you another, I think practical examples, real life examples are helpful. So I'm working on a case right now, a raise, where the plan is to essentially take out, and remember we talked about several different classes. So the plan here is to take out investors. So somebody's going to come in with a big chunk of dough. It's about $1 million. And the plan is that after a year, we're going to return the $1 million and they're going to be out of the deal. Well, that mechanism, so again, the PPM, the business plan might talk in generalities about this is kind of the game plan, but the operating agreement needs to have that procedure in place. Like, okay, so when I give you your money back after a year, if I don't have something in the operating agreement that says you're basically getting redeemed or you're getting bought out or what have you, they're going to get their money back and they're still going to be a 20%, 30% owner in the LLC. You need that mechanism to get them out. Similarly, in that same deal, there's an issue of depreciation. Some of the investors are not getting depreciation for a variety of reasons. Again, that has to be in the operating agreement, because it's not in the operating agreement that under the tax section, then that's just not going to govern. So it is important. I mean, that's one of the jobs of if you're the issuer and the sponsor, that's one of your jobs of the attorney. And so that's one of my jobs I audit. I shouldn't say audit, I underwrite every single deal to make sure that it all makes sense. That's why I'm looking at the pro forma to make sure that the numbers add up, that the waterfalls and everything that's in the pro forma actually matches to what we're claiming is going to happen. And so if you're a passive investor, if you're on the LP side, then you also should have somebody review it. And it's probably going to cost you, let's call it a round number, probably $1,000. It's probably a couple hours of the attorney's time, 2 or 3 hours. Between an initial phone call to kind of, I'll just tell you what my process is real quick, because this might be helpful too. My process was pretty simple, but it was essentially, first I did a phone call to understand from the client what their understanding of the deal was. So they would tell me, I'm putting in 50 grand. They're going to go do this. I'm going to get a 10% preferred. I'm going to get this. I'm going to get that. They're promising me this. And I get an idea of what they would do. Then I'd go through the documents in detail and do two things. Number one, make sure that the documents match the client's expectations, so that if they told me they thought they were going to get a preferred return or something, I wanted to make sure that language was in the documents, because if it wasn't, then I'd go back and say, the part where you said you thought this was happening, well, I don't see that anywhere in the docs. And second of all was just these red flags. Again, either in the worst cases, documents were completely missing, but in other parts, just the way the language happened, they're just things that, maybe the manager was able to do something that most people generally wouldn't allow them to do, but it was in there. And so I would highlight those sections, kind of red flag. And then you have that kind of last call with the client to kind of go over the differences between their expectations and what's actually in the documents.
That's a huge knowledge drop right there. I mean, expectation versus reality. Wow. I mean, that would save you so much time and headache. And $1,000, I mean, that's like doing a property inspection and a sewer scope on buying a house, right? We all do that, and we will absolutely walk away if the property inspection is too bad. renegotiate, which is difficult to do in syndication with the operator, but
Yeah.
or just simply decide that that doesn't make sense. So let's talk
Yeah.
about members. So we see these syndication documents and they talk about A units and B units and C units, or and it gets
Yeah.
kind of confused. It gets kind of confusing. But most what we're really talking about here is the managing member or the management, and we're talking about the limited partners or the investors, right? And some people call the investors, the limited partners, Class B. Some of them call Class A. Some vice versa. At Spartan and Mauricio, your clients, I think you usually kind of advise them to go Class A for the passives and Class B for the manager, and that's at least the operating agreement that I read from you was specified that way, and that's how ours are done. But it doesn't really matter if you call them Y, Z, A, B, whatever.
Right.
You're just basically making a distinction between who's putting in the money and expecting a passive return and who is managing the project. So,
well,
let's talk.
Right, yeah. And it's a little bit more than that too, because what happens is the reason there's really two reasons, and I can only talk about why I do it. I don't, a lot of people do it, and they have different reasons. The reason I create two classes are twofold. Number one, each class can be treated differently. So if I want to create something different, so typically passive investors have some kind of a preferred, even if they don't have a preferred return, as we'll see later, they are at least entitled to get their money back before certain splits happen. So they have a preferential treatment. And so that's why you want to separate A from B. And even within A, within your passive investors, you may be treating them differently. Maybe some investors are giving them a higher preferred or a higher return because they're putting in more money. Or maybe some of the investors are self-directed IRAs, so they don't care about the depreciation. So you're not going to give those guys depreciation, but other people you are. So anytime you start making distinctions, you've got to treat everybody equally. You can't just arbitrarily start giving preferential treatment to people. But if you create these different classes, and you don't have to just create two, you can create in theory an infinite amount. I wouldn't go too crazy, but you can treat people differently. So that's number one of the reasons I do it. And then the other reason, which I guess is related, is I want to make sure you as a syndicator maintain all of the control in the property or in the syndication. I don't want you to go through all this work of finding the deal, raising the money. God knows you got to talk to attorneys, and that's probably worth your acquisition fee alone. But the last thing I want to happen is you start this deal and then the rest of the members just vote you off the island. So I make it really difficult for them to do that. And the way we accomplish that is by putting, again, it's a preferential treatment. I'm giving all of the voting rights, or 99% of the voting rights, to Class B, so that they retain control. So it makes it really difficult for the Class A members to really, as I used to joke, vote you off the island.
Yeah, no, that makes a lot of sense. So let's talk about tax benefits then. So both members receive tax benefits. There's pass-through, cost segregation, bonus depreciation, losses. My understanding is that both the limited members and the managing members are getting those benefits.
Yeah, so I'll give you my disclaimer again from the beginning. I am not a tax professional, and I certainly don't even play one on TV. But I do these enough, and I talk to CPAs all the time, so I have a good working knowledge. Yes, the answer is, I'll give you a couple different answers. The answer is yes. The Class A members, the passive investors, absolutely are entitled to sort of the pass-through and all those benefits. So as a passive investor, you do get the bonus appreciation that comes in, any kind of deductions that you would get if you owned it yourself, that would pass through. What most people forget is that the ownership percentage, so let's just say this is just for ease, and it's typically not this way, but let's just assume it's a 50-50 where the Class A owns 50% and Class B owns 50%. Couple things. Number one, the tax benefits don't have to flow, as I understand it. Check with your tax professional, which by the way, I do. Anytime we do something like this, I always insist that the client loop me in with their CPA, even if I know the answer or I think I know the answer, because I've talked to other people. I want to make sure that your CPA agrees and I'm getting the sign off from your CPA, because in my experience, and it's unfair to CPAs that I say this because it's probably true for lawyers too, but you ask 3 CPAs the same question and you get 5 different answers. So sometimes there's such a dispute that one of the CPAs might say, yes, you can do this, other people don't. That's why it's important to make sure you follow your CPA. But just because you're 50-50 doesn't mean that you each have to have 50% of the depreciation, for example. Like I mentioned before, self-directed IRAs don't care about the depreciation generally. So a lot of people, set it up so that they don't get any of the depreciation, and maybe they get another benefit because of that. But you don't have to match the ownership with the depreciation, just like you don't have to match the ownership with the distributions. You don't have to go 50-50 on distributions. You can give 70% to one and 30% on the other. There are some limitations, which is why you want to talk to your CPA. So and I forget the technical term for it, but there has to be some kind of, it has to either be reasonable, there has to be some kind of economic, reasonable or substantial economic, the connection. So I don't think you can go zero just because you wanted to, but you certainly don't have to match it up percentage by percentage. So, but the bottom line is, yes, absolutely, the passive investors do get the same tax benefits as if they owned it themselves. They would just get obviously their pro rata, or I shouldn't even say the pro rata, just whatever the distribution allocation that you've decided to come up with. They just follow that.
Absolutely. So bottom line here is just make sure that if you are expecting, again, expectations versus reality, if you're expecting 50% of the bonus depreciation and tax pass-through benefits, and your legal team reviews these syndication documents and it's not cut up that way, it may be a surprise that you find out later on, and it may be 18 months later when the return is filed for the business. So definitely worth asking your sponsor that, and also making sure that you're going to get what you expect. So just kind of quickly go through these. Receive a preferred rate of return. We're going to talk about that in a minute. Usually the managing member or the members of the managers of the LLC are going to bring on all the debt. But this is specified in the operating agreement, who's responsible for encumbering debt, who's going to go get that. Usually the passives, at least in our documents, are not taking on any personal debt or guaranteeing any debt or making any loans to the company. There are mechanisms I saw, Mauricio, and correct me if I'm wrong, to do that, but there's it's all spelled out and it's very specific on how that gets done. But generally in the business plan, the managing members are going to go get the loans for the property. And you're not guaranteeing any debt for that.
I think the only exception to that, and this is not a legal requirement, but sometimes the lenders, if you own a certain percentage of the deal, maybe it's 20%, sometimes it's 10%, but generally I think it's 20%. So if you have a big investor, then the lender may have on their side, their policies and procedures may require them to underwrite that 20% owner, or maybe have them guarantee it. But that's certainly not a legal requirement. It may be a lender requirement. And again, every lender is different.
That's a great point. Thanks for bringing that up. And then management fees, typically the manager is going to collect some type of fees, and all of those fees that they're going to collect should be specified. So what's common is a acquisition fee. The manager will pay themselves, a percentage for finding the deal, raising the capital, finding the, operating the facility or doing the asset management or property management. Sometimes they do a disposition fee where they pay a fee when they sell the asset, when they refinance the asset. So all of those fees, any money that is going to the manager needs to be specified in your operating agreement. So that's kind of really an important thing there.
And there's sometimes a debt guarantee fee. So somebody, I think they call it an underwriting fee, or maybe it's a point. So one of the members, again, the managers are guaranteeing the debt, and therefore they're putting their balance sheet, and sometimes they put a line item to get compensated for that, except in the park and everything else. So the fees are important because not only should they be spelled out in the operating agreement, obviously, and obviously also in the PPM, but the disclosure of management fees is key. That's the one thing that everyone, especially the states have been stripped away from a lot of their powers. Most of these laws are federal laws, and the states don't have much power. I always joke they're sitting around twiddling their thumbs because they've got nothing to do. But this is one place where they're going to look very close, and it's not just direct fees, but any indirect fees. So, for example, you may be a real estate agent or a broker, and therefore you're going to sell this property, and you're going to do the deal, and you're going to get 3% of that. That's fine. Just make sure that's disclosed. Maybe you're buying the property from your spouse or from your brother. That's fine, but that's another disclosure. Even though it's not compensation directly to you, it's compensation to a relative, so all of that stuff really needs to be disclosed, because that's what the states really focus on when they've got their hands on something. Great.
Yeah, and act as an agent. I think this might be, straightforward, but for the purposes of talking about it, the way I understand it is, as a limited member, you can't go acting like an agent for the investment or the property, right? You can't go and negotiate terms or contracts or anything like that. You're not going and telling the contractors what to do. You are completely limited. So that's what the managing member does. Well, great. So we'll go on to the next slide here. So let's talk about the manager of the, or managers, I should say, of the syndication.
Yeah, so this also can run the gambit. I think most people, most syndicators, and I think I'm a little bit more lenient than most, but most syndicators give all of the power to the manager, right? They say, limited partners, you have zero voting rights, you have zero powers, you're giving me your money, and you know, keep quiet. You're not allowed to say anything. I always like to carve out, obviously. So the company manages. There's a section that outlines all the powers. And there's certain powers that I like to point out. For example, if you're promising, or if the operating agreement says you're going to get a 15%, well, maybe not go that high, but let's say you're getting a 10% preferred return. In my mind, obviously the manager can't just unilaterally change that tomorrow and say, well, now instead of giving you a 10%, I'm going to give you a 5%. So things like that, I like to give the limited partner a little bit of veto power. Same regarding, taking out, for example, personal loans, right? You wouldn't have the manager loan money to itself for its personal, for its personal benefit without the approval of the managers, or any of these preferred allocations, any of those changes. I kind of like the limited partners to have to say. But in general, a limited partnership investment is just that. You have very limited rights, and this is the section that will outline and disclose that and really articulate what the manager can and cannot do without the approval of the members, or whatever that procedure is. So you're right. It has full, in most cases, they have full authority, especially the day-to-day. This is a section where you would outline what we just talked about in the prior slide, where all of the compensation that they're receiving, to me, it's very clear. It's like, here's the compensation. Number one, boom, acquisition fee. Number two, disposition fee. Number three, an asset management fee. Number four, 30% of the company. Number five, just 1, 2, 3, 4, 5. Very, very simple. Make it very clear. Devoting the time is a good one too. A lot of you guys are doing multiple projects. You still have day jobs. Some people have side businesses. So it's not an expectation that the manager is going to be spending 100% of their time working on this project. And so that's something that gets in there, because you don't want to have a situation where it turns out that something goes wrong and somebody goes, well, the reason it went wrong is because, this person was off doing something else. And that's going to be something that's clearly stated in the operating agreement, that the manager does have the power to go do, other businesses. And sometimes they may even conflict. I don't think we're going to talk too much about conflicts, but sometimes they conflict. Maybe they have another syndication, which is another property that's in the same market as the other syndication. And so you're kind of, in theory, maybe competing. And again, that's something we disclose, and that's something we say is okay. Because again, if it's not in the operating agreement, then it may not be okay. And somebody may want to say, wait a minute, you're competing with us, and that's illegal, and you're breaching the contract. And so you want to have something in there that clearly states that that's permissible.
And that's something that we'll talk about too on the doing due diligence on a sponsor. The number one thing you should ask yourself is, how many projects does that person have going on, and who is on their team, and do they have the air cover to actually do all the projects that they have in their portfolio? And what are their plans for growth and expansion and being able to cover down on all the projects that they're doing, right? So I think that's something that kind of go in there. You don't want somebody who is just a one-man band and he, is trying to do everything on a project, and he's got 18 different projects going on. Your project's probably not going to get much attention, right? So very important there. So let's talk about the removal of a manager and kind of some of the safety nets that sponsors can put into place. And why we would be able to remove a manager, and kind of how that would be sort of executed. How would we say you're officially thrown out? Who does that? Is it all the limited members getting together? And sometimes you don't know who the other limited members are. I mean, in our deals, we share that information, but how do you even get all that information together to do something like that?
Well, let me address that last point, because that comes up a lot. I get some pushback we do the same thing in our docs. So the operating agreement will actually list all of the investors and their contact information and the amount they invested. And the reason that's in there, and again, I was thinking about this the other day. Now that we're in the 2019, maybe the actual mailing address isn't irrelevant. Maybe you can just put an email address on there. But there has to be a way. One of the things we didn't talk about, but obviously let's talk about the removals. There's usually a notice requirement where if you want to do something, you have to call a meeting. If you want to remove a manager, you're going to call a meeting. If you're an investor, you're going to call a meeting and have enough people at the meeting and have enough votes to do whatever it is that you're trying to do. And so how do you call that meeting if you don't know how to contact everybody? So having, that was the issue with the email. I don't like the email. That's right. We thought about the emails, but then the last thing you want to have is everybody having everybody else's email, because they can easily start a group, and now suddenly everybody's in contact with each other, and you have one bad apple in there kind of stirring the pot. So let me retract that and go back to my mailing address. So that's why the mailing address is in there. So if you're required to give notice, that you've got somewhere to actually send these notices. But I make it really hard. This is just my own docs, right? Everybody's different, and there's no right or wrong. But I represent the sponsor, I represent the issuer, so I'm looking out for their best interest. And so I make it virtually impossible for the limited partners to remove the manager. And the voting requirement is very high, and it's even higher when you take into account the split. So even if it says, I'll give you an example, it might say 75% vote required in order to remove. Well, you already own 20 if it's an 80-20 split. So, you really, in reality, because obviously you're going to do the 20, you almost have to get like a 9. You basically have to get everybody to agree. And in certain circumstances, everybody will agree, because you've done something so hideous, and that's where you're going into. If you commit a heinous crime, or you're stealing money, or you're, reckless, or you're intentionally defrauding, clearly everybody's going to, agree and vote you off. And so what I typically do is I outline, just like you did here in the slide, the circumstances by which the members would be entitled to do a vote to remove, and I call those removal for cause. So typically there's removal for cause and removal without cause. And I definitely do not allow any removal without cause. So just because you want to get rid of the manager because you don't like the way they're doing it, that's not going to cut it. But for cause, and again, I outline all these things, like I just mentioned, crimes, intentional. I go a little bit stronger than willful and continued failure. I really want to make sure it's reckless or intentional or fraudulent or, intentional misrepresentation and, all that kind of stuff to make it really difficult. And even then, the way I draft them, again, just totally protecting the sponsors, they have the right to remove the manager, so they do not have the right to elect a manager. So the Class B still has that right to elect a new manager, which is obviously, you're controlling it. So you're basically going to end up in a stalemate situation, because they're going to want to fire the manager, which they will. You're going to hire a manager that's your manager, or maybe just create a new entity that's the new manager. The investor's going to say, wait a minute, that doesn't work, so I'm going to fire them again. And you keep, so it's just kind of a vicious circle, and it just forces everybody to come to the negotiating table and come up with a solution. And then worst case scenario is you end up going to court and having a judge decide, if there's a stalemate.
Great stuff. Okay, so we're going to go ahead. We're going to jump into how we make money, right? And what you're looking for in a operating agreement. I guess it's not the how; it's just the mechanics of distributing profit. So, if you don't mind, I'll try to take a stab at this as best I can, and then you can just correct me on anything that I might be a little bit off on.
Yeah.
So this actually comes, this is very abbreviated, but comes from one of our operating agreements at Spartan. So we say that net distributable cash from operations, so first to members to their preferred return balances until the preferred return balance is reduced to zero. So basically what we're doing, and we got a great example below this, we take, if an investor invests $100,000 and there's $8,000 worth of profit to distribute to that investor, we will basically give them that first rate of profit, which is the preferred rate of return. What we also do is we usually do a rolling preferred rate of return, meaning that if that first year they hit 6% and the next year we hit 10, the 2% is made up from the previous year's delinquency, and we'll get into how that can be caught up in the refinance as well in the next slide. So in this instance, we did a deal. The chart you'll see, we raised this is just an example. We raised $1 million of equity, and we are specifying in our operating agreement an 8% preferred rate of return. And I want to stress, when people say that there's an 8% preferred rate of return, it's absolutely meaningless to how much return will actually come from the project. So clarify that the 8 pref is just meaning that you're going to get the first 8% of profits. It doesn't necessarily mean that the business will produce that much profit. It just means that you have the rights to the first 8%. So kind of a little bit of a marketing spin on things. When you hear the 8% pref, you think, oh, my return is going to be 8%. Just verify that that's actually going to be the return, different than the actual return that's being forecast for the asset. And let's say after an 8% preferred rate of return, we do a split 50-50 based on the ownership of that individual. So if we raised $1 million and the property made $100,000, and in this scenario, $80,000 would go to the investors paid first, so the Class A units in this case. So $80,000 goes to the pref, and then there's $20,000 of profit left to split. So it would go 50-50 with the A and the B. So your sponsor or your operator really has only made $10,000 in this case. So the business made 100, the sponsor makes $10,000, which is half of what the $20,000 is. Now, the sponsor could have made money on asset management fees, property management, acquisition, things like that. But generally, the proceeds from the business as you're operating it, in this situation, a majority of those proceeds are going to the limited partner or the investor. Anything to add to that or subtract?
A couple things I want to highlight, but yeah, you were spot on. Let me just highlight a couple things. We're going to get to the second slide, but just again to pull it back, totally different when you're analyzing the distributions from operations, which is basically the money that comes in from rent and your monthly cash flow, and you're probably doing a quarterly distribution, but that's one set of rules. And then it's completely different for when you actually exit, either in the form of a sale or a refinance. So just keep that first differentiator. I was going to mention exactly what you mentioned. The preferred is not a guarantee. A lot of people say 8% pref and like, oh, I'm going to get 8%. No, just like you mentioned, Brian, all that means is you're going to get 100% of the money until you hit that number. And if there's no money, you're getting no money. So your return to be zero. If you lose money, your return to be zero. So that's an important thing. The other thing I'll just touch upon briefly, just because I want you to be aware of it. If you don't get your mind around it, this is new to you, then don't worry about it. I just want you to be aware of it. But there's probably at least 3 or 4 ways that preferreds are structured. This is kind of the standard one that most people use. A variation of that is some people, when it's time, if you don't hit that pref, you lose it. Like in this scenario, you get to catch up, you get to make it. So if you only got 6%, then that other 2% will be paid next year along with your 8% next year. And then you can really fall behind in the early years and you have to catch up. Some people just say, look, if you don't get your 8%, you're out of luck. Next year you're just going to get 8%. It's not going to roll over. The other way that it's done, that's the next most popular, which is a slightly different, is you can say, look, I'm going to split it 80-20, but I'm going to give you a floor of 8%. And so if we do an 80-20 split and you're only getting 6% return, I'm going to start throwing money over the fence from my side until you get to that 8%. And that's just a slightly different way of structuring a pref. But just know there's not one way. Just because somebody says it's preferred, don't assume this is the way it is. There's multiple ways that you can structure a pref.
That's a really good point. And again, we like to keep it simple in ours. If you're getting into a deal and it's like, well, then you get this, and then you get this, and then there's a waterfall on top, and then this comes back.
Oh my God.
Sometimes, we like to say confused mind says no. So if you're getting into a deal and it's just really confusing in how you get your money and you're confused and you can't understand it, maybe it's time to move on. Or, ask the sponsor to clarify it. And if it's hard for them to explain it, then it might be hard for them to remember it, right? Or, do they have the accounting in place to actually properly, distribute the capital? So let's talk a little bit about.
And Ryan, real quick, we learned that, we meaning the real estate guys, Robert and Russ, we learned that the hard way. One of the early deals that we did back in the day, we had a really complicated waterfall where it was like, well, the first tranche of money gets split with this preferred, and the next 100,000 gets split 80-20, and the next tranche gets 50-50, and the next tranche was 20-80. It just got so confusing that you're right. People have this, paralysis of analysis, and our guys had a hard time explaining it to investors. So keep it simple. Yep. I would encourage you guys at most go 2 levels if you want to go 1 more level down, but don't go too crazy with your waterfalls, even though it can be tempting to get creative and really fun. But if the investor doesn't understand it, then that's a problem.
Makes sense. So let's talk about refinancing. I'm going to take a crack at this one. First, to Class A units until their capital contribution balance is to 0. So if you invested 50 grand and we had a refinance event, we have these planned for a lot of our projects where we go and we improve the property. It has a higher valuation. We go in, we do a refinance, we suck out money. In this case, I'm giving you an example. where we take out $1.5 million from the refinance, we would first return that capital to our Class A members' capital contribution, meaning that the amount you invested. So if you invested $50,000 on a project and we did a refinance, this is the order that's specified in the operating agreement, that you would get the $50,000 back first before the sponsor would get anything from the refinance. Second, the Class B units, which is us, any cash capital contribution balance, we would get back. So if we're investing in the deal, or if we got cash in the deal, that money would come back at that point. Obviously, no money is coming back till all expenses are repaid. That's the first thing, right? We talked about that a little earlier. But then the third, the Class A units, until their preferred return balance is reduced to zero. So as Mauricio mentioned in the previous slide, and I kind of brought up a little bit, the rolling preferred rate of return could be present in some deals and not in others. So that's a very important thing to clarify. You know, ours generally have a rolling preferred rate of return. So let's just say for the previous 4 years, we said that we had an 8 pref, but in the first year was 2%, then 2%, then 2%, then 2%. We would then calculate, you know, we would have a deficit that we would have to pay back in the refinance for those previous years where the investors didn't receive the full 8% preferred rate of return that was outlined in the operating agreement. So that was that's when it would be repaid back. In this case, and the example I'm giving, I'm saying there was $1 million of equity. We got a 1.5 back from a refinance, and we hit the pref throughout the investment, so it's good. So in this case, in the third, the Class A units wouldn't get anything in this example. So, and then fourth, to members in proportion to the respective percentage interest. So essentially, if it's a 50-50 split on top, we would split whatever is remaining. So in this case, I said $1 million came back, $100,000 came back to the manager. The pref was hit in the previous year, so that was at zero. And we're saying that there's still money left over now. There's $400,000 left over. The first, second, and third tranches were paid per the operating agreement. So the last $400,000 that comes back, we split 50-50 in this case with the equity and with the manager. And again, it could be 80-20, it could be 70-30. You just have to look in your operating agreement and understand what you're kind of going after. Anything to add or take away?
Two quick points, because I know we're running tight on time. Number one, the percentage, the 50-50 that you're mentioning, that split does not have to match either what you were doing at the operations above, and it does not have to match your percentage interest. So some people, for example, might split operations 80-20. Let's say it's an 80-20 deal, so you're splitting everything 80-20 on operations, but when it comes down to sell, you split that 50-50. So just know that it does not have to be equal. There's no requirement. In fact, some people decide to take more money in the back end because they want to get paid their big bucks up on sale. And the other thing I just really wanted to stress with that first point that's critical is that whenever you do a refinance or a sale, again, this is from net cash flow. So this assumes now you paid off your debt, you paid off all your fees or whatever. Now you've got money that's left over. 100% of that money first has to go back to the investors to make them whole before you go anywhere else. Some people start divvying up, returns right away, and they forget about that. I literally had a case last month where they didn't do that, and I pointed it out, and they had to redo the numbers, and then the numbers didn't work, so they didn't do the deal. So that's critical, and that's the one thing I wanted to highlight.
Very good. So real quick, I know we're running short on time, and I wanted to leave a little chance for Q&A. We're almost to the end. Capital contributions. Let's just talk about, let's just go right to, we all know that you got to contribute capital. Let's talk about capital calls. When the LLC, if the business runs out of money, what happens?
Whatever you want it to happen happens. Typically, the way I do it is twofold. So there's two big ones. Number one, we make it so that the cash call is not mandatory, because you can make it mandatory or not, and we make it not mandatory because most investors want to know that if I put 50 grand, this is it. Like, I don't have to put any more money. So that's an important distinction. You got to make a business decision right off the top. So typically we have a provision that says it's not mandatory. However, that doesn't mean if they don't pay their cash call, there's no consequences. What typically happens is once there's a cash call, everybody needs to pay their cash call according to their percentage interest. If for whatever reason, which always happens, there's a couple people or maybe a lot of people either can't come up with the cash flow or don't want to or what have you, so you're short. So what has to happen is either you have to get more money from the existing members. So even though my cash call might only be $5,000, you're asking me to put in 7 or 8 to cover the people that didn't want to put it in. Or you have to go to the outside. Well, I guess you could also loan the money. The manager could loan the money, or you have to go get some more cash. And so you can either then penalize the non-contributing member by either diluting their interest. So now more money came in, and so now they're going to own a smaller percentage. What I like to do is I simply have a lien, basically a note. So if somebody needs to pay $5,000 and they don't, and Mauricio, who's one of the other members, steps up and makes that contribution on their behalf, it's essentially a loan that I'm making to the other member. That loan is then secured by the units, the membership units, so that in the future, when money is coming back in and everything hopefully has been stabilized, or if we sell the asset, you're going to pay me my interest rate, which I put at the lower of 18% annualized or whatever is legally allowed, and it's usually a lower number, whatever the legal. So let's say it's 10%, but I'm getting a 10% loan, and I get paid first. My note gets paid back first before you start seeing any contributions in the future. So that's my mechanism. But again, there's so many different ways you can skin this one. You can make it mandatory. You can dilute people. You can do the loan system. You can be as creative as you want to be. I would keep it simple, and I think the loan is easy to understand, and that's my preference. But if a client wants to do it a different way, then I'm all ears.
So, takeaway here, right? How liquid is your sponsor? How much cash are they raising for operational reserves? That would be one of my first questions when looking at a syndication is, if this business runs out of money, what can the sponsor do? What has a sponsor put in place to make sure that there won't be a capital call? Because that's important, right? If the sponsor is just raising the exact amount of money that he or she needs for a syndication, that might not be enough. And so you've got to really understand the financials and how much they're going to have in operating reserves to run their business. So that's obviously a different webinar, but something to stress there. So perfect. Just going to run through. So just kind of some post-investment expectations. So, when you're investing in these projects, you should have regular communication and project updates from your syndicator or your sponsor. I mean, monthly, quarterly, some type of frequency. K1 should come in March, so you can do your tax return on time. Member meetings and minutes, obviously corporate formalities for the operating agreement, distributions, if it's one time, quarterly, monthly, just as long as it's happening, per the operating agreement and how the business is performing. And, we print out the corporate docs and mail them to all of our investors. It's just kind of a customer service touch, not required, but I would definitely have a way of organizing all of your corporate docs. So I wanted to have some time for questions. We'll open it up for 5 minutes or so. Hopefully we can get as many as we can here, but I put up the contact information for Mauricio and myself on the screen. If you have a question, you can email either one of us or call us after the event. I've also uploaded this slide in PDF in the handout, so you guys can have a copy of this presentation. So first question I have is, how do the docs in your syndication differ from investing in a startup?
They shouldn't be any different. In fact, you are a startup. So most of my clients, if you're buying a piece of property, you're creating a brand new company, and it's a startup. So it's going to be very similar. Obviously, a startup, typically when you say startup, I'm thinking of a business, an operational business, as opposed to real estate. But so that'll have different disclosures, different mechanisms. But it's not because it's a startup; it's because it's a business operations versus property. But all of my clients essentially are startups, because you're starting a brand new company every single time you go buy a property. There's no operating history. You've got the money, as Ryan pointed out. You may not have too much reserve, so you're kind of on a tight budget and you're bootstrapping it. So I would say there's no difference based on that criteria. It's just the startups are obviously a business, and you have different business risk factors and different different things that are common in that industry.
Makes sense. And anybody can ask a question here. This is the Q&A section. So on the GoToWebinar, you can raise your hand, type a question into the question field, and then you can ask Mauricio or myself anything that you want in context of what we're talking about.
While we're waiting,
yeah.
While we're waiting, I wanted to share a quick nugget on the last slide, because this came from Ken McElroy. who's a Rich Dad advisor. He's probably one of the best indicators I know. But in terms of communication, he said something that I think is gold, which is when things are going badly, that's when you want to over communicate. A lot of people do the reverse where things are going bad and the investors are going to be upset and they stop communicating with you. Kenny's a big believer in the opposite. You over communicate when things are going bad, and that builds trust. And it also makes life easier because now they know they're not happy, obviously, but getting regular, the worst thing you could do is go silent and go dark, and the investors just get really frustrated, they get scared, they don't know what's going on. If you're upfront, letting them know exactly what's going on, assuming it's not, you're not you're not stealing from them, then that just builds huge trust. So I just thought that was a gold nugget when he shared that with I can't remember what the context of the sharing was, but that's something to keep in mind.
Yeah, I can't agree with that more, actually. What we do now is at Spartan, we do an email and we do a teleconference every quarter. Because some people just don't read emails or they don't get them or they go to spam or whatever. But we do a conference call every quarter, and we go open mic, so people can ask whatever they want in front of all the other members.
Nice.
Just for transparency sake.
Yep.
Because I agree, communication is everything, and I think it makes it easier to do a deal because if everybody knows what's going on, they're part of your team and they're not, alienated against you as the sponsor. So
Right.
definitely a good thing. Any other questions? I don't have any questions coming in. We have quite a few people on the.
If someone comes up, because this happens also when I do my strategy consultations, and I do complimentary 15-minute calls. So if somebody wants to do one with me, please feel free to reach out. But a lot of times, people remember questions after we hang up the phone call. So you've got my email address. If you've got any questions that come up, just shoot me an email. Just reference that you were on this webinar, and I'm happy to answer them. As quickly as I can.
Sounds great. Thank you so much, Mauricio, and I appreciate your time and help putting this together. And we'll talk to you on the next webinar. Thanks, everybody.
Thanks, Ryan.
All right, take care.